In the incredibly tough world of insurance, some companies just seem to play on a different level. And today, we're taking a close look at one of the absolute best, W.R. Berkley. If you're an investor, this company is a fascinating case study in how to truly excel. So let's just start with this one number, 23.6%. That was W.R. Berkley's return on equity in 2024. Now, to put that into perspective, their own long-term goal is 15%. So, yeah, this isn't just good. This is truly elite, top-of-the-class performance. And that, of course, raises the big question. How on earth does an insurance company pull off numbers that would make a Silicon Valley tech firm jealous? Well, let me tell you, it is definitely not by accident. It's by design, and we're about to break that design down. All right, first up, let's explore the bull case. The whole argument for W.R. Berkley really boils down to three core ideas that work together to create what some people call the Berkley machine, a seriously high-performance engine in the insurance world. Okay, this right here is what makes Berkley so different. Instead of some huge centralized bureaucracy, think of Berkley as a collection of about 60 different specialist businesses. Each one is nimble, almost like its own little startup. And they focus on these really complex niche markets where you win with expertise, not just by being the cheapest. This whole setup lets them pivot and react to what's happening in the market with incredible speed. And that agile structure fuels two powerful profit engines. First, you've got just really disciplined underwriting. That's the business of selling insurance. Their combined ratio, which is a key measure of how profitable they are, was a fantastic 90.3% in 2024. Then, the second engine is how they smartly invest the float. That's the mountain of cash they hold from premiums before they have to pay out claims. And in 2024, that engine alone kicked off a record $1.3 billion. But look, a decentralized model like that, it just doesn't work unless you have the right culture. And that brings us to the final piece of the bull case, a genuine culture of ownership that starts right at the very top. This, right here, is what skin in the game really, truly looks like. The insiders at W.R. Berkley, we're talking the founders' family and management, they own over 23% of the company. Just look at the comparison to a great competitor like Arch Capital at just over 4%. For the people running Berkley, this isn't just their day job. It is their own money on the line. They think like owners, and that means they're making decisions for the long haul. So you've got a fantastic business model, a founder-led culture, and just incredible results. You'd think the investment case is a slam dunk, right? But, as always, there's another side to the story. And if you look closer, there's one pretty big concern that really forms the heart of the bear case. Now, before we get into what that concern is, we gotta quickly cover a super important concept in insurance: loss reserves. Basically, this is the pot of money an insurer has to set aside today to pay for claims that have already happened, but haven't been settled yet. Getting this number right is one of the hardest and most critical parts of the business, because if you get it wrong, the profits you think you have today could just disappear tomorrow. And this is where it gets tricky. This is the core of the debate. On one side, you have some outside analysts pointing to Berkley and saying they might have the worst positioned reserves among their competitors. But then you look at the company's own numbers, and they're reporting a net favorable development. That means they're saying their old estimates were actually too cautious. So as an investor, you're looking at a flat-out contradiction on a really critical financial issue. And beyond that one big debate, you also have to factor in the risks that just come with the territory. The insurance business goes in cycles. A soft market with brutal price competition could really squeeze their profits. Then there's the stock's price. It trades at a high premium compared to its peers, which means the market is already baking in a ton of success. And of course, you can't forget the risk of huge catastrophes like hurricanes, and just the fact that this is a super competitive space. And this table really puts it all into perspective. Just look at that return on equity, 23.6%. It absolutely towers over these other fantastic companies. Their underwriting performance is also right up there with the best. But then, look at that PE ratio. The market is absolutely rewarding Berkley with a premium valuation, pricing it way higher than its peers. So where does all this leave us? Well, on one hand, you've got what is clearly a best-in-class company with a proven model that delivers incredible results. But on the other hand, you have to pay a premium price for it, and there's that one big unresolved question mark hanging over it. So really, the question you have to ask yourself as an investor is this: Is the company's unique model and culture strong enough to create a real, lasting advantage? An advantage that's not only worth that premium price tag, but one that can also handle the major uncertainty surrounding those loss reserves. Ultimately, it all boils down to this one question. You've got the bull case, a phenomenal, well-run business, and you've got the bear case, a potential risk hidden deep in the financials. Is the reward of owning one of the best in the business worth that uncertainty? That's the question you, as the investor, have to answer.